Hello, everyone. Thank you all for joining us. Here we are starting off the new class of diverse investors panel. I guess the goal of the panel is to highlight stories of diverse VCs that are helping build the future of the startup and venture ecosystem, and also discuss advice on breaking into venture and also advice on receiving funding as minorities. So here we have Justin, Leslie, and Chad, who are our panelists. So I guess if you all could start off with introductions, that would be great.
Great. I'll let ladies first. Leslie, if you want to do that.
Sure. I'm Leslie Harwell. I'm managing partner of Alante Capital, and we're a venture fund that's focused specifically on the sustainable transformation of apparel production and retail. And while I'm based in Atlanta's my hometown, we invest across the US and in Europe, and we're a female-founded fund, so both my business partner and I are both women. And over half of our LPs are women, as well as actually 2 out of the 3 of the founders of the companies we're currently invested in are also female. So we're focused on creating a pipeline that's diverse, both in terms of gender as well as race and backgrounds, academic backgrounds, all sorts of things. So that's more about us.
Cool. I'll jump in. So, hey everybody, my name is Justin McLeod. So I'm a partner at Outlander Labs. We're a new early stage fund investing in most of the pre-seed stage and seed stage, if it makes sense, but we focusing on the Southeast. We're pretty much agnostic. We kind of don't focus on anything that's not cannabis or cryptocurrency, but we're really founder focused. And what that means is like, we believe in people who, have really outlandish ideas and big ideas. So we're looking to kind of shake it up here in the South with our managing partner, Paige Craig. So well-known angel investor who invested in Postmates to Bird to Lyft. So we really want to bring that B2C focus as well down here to Atlanta in the South. So based in Atlanta, and we're excited to, get things on the road. So that's it.
Hi everyone, my name is Chad Harris. I'm a early stage investor here in Atlanta, Georgia, focused primarily on seed and Series A investments. Primarily focusing in the tech sector, but anything tech enabled and a little bit outside of the boundaries on either side of that, definitely taking a look at as well. Morehouse grad originally from Memphis, Tennessee. I'd say I'm new to the full-time investment space. I've spent a lot of time around the space, both private investments and in other capacities as well. But here within the last several months, focused solely on venture investments.
Cool. Thank you all for those introductions. So I guess for each of you, could you discuss your path of breaking into venture capital, like your background, and why did you decide to pursue this space?
Sure. Do we want to go the same order?
Yeah, that's fine.
So I spent the first 10 years of my career working at investment banks, and the first 7 years I was focused on emerging markets and really saw the need for technology to make a lot of the changes in the countries where I was focused, and think about progress and poverty alleviation, changes like that. But as I really started sort of thinking bigger about what that meant from a finance and an investment perspective, I started getting interested in impact investing as that became a thing. It was not a thing when I first graduated from college, but thinking about how you find new companies that can have great financial returns alongside social or environmental impacts was something that was super interesting to me. And so I moved from the first job that I had, an investment bank, to another investment bank that actually had a group that focused on that and focused on investing in VC funds where the managers of those funds had some sort of theory of change and some sort of impact that they were trying to make with the funds that they were doing. So that was kind of my background, was shifting from a focus on emerging markets to really more sustainability broadly, both social and environmental, and finding a place to do that within a large investment bank, and then eventually spun out with my business partner and founded our own fund that had a specific focus that we felt was kind of missing out in the market.
Awesome. Yeah, so I'll jump in. So I'll probably have the most untraditional path on this call to venture capital. So my background, so I started my first startup company back in 2015. It's called EventSense. So basically, think of Snapchat or Instagram stories for events. So before those people, those companies had that out, it was basically you just got to look before you go to it, and built it up with the team, raised capital, and we launched in 2016. Had a lot of traction, but we didn't have enough funding, or wasn't getting too much revenue coming in. So of course, the funding, depleted. So I still wanted to stay in the startup ecosystem. So what I did was create a marketing agency, which I run today called Survive, and really just kind of just staying in the ecosystem until I had my next like big idea. So I started kind of just being a value add to the ecosystem here in Atlanta by creating different workshops, panels, different events, just helping out with different projects. And one of those events kind of led me to my role at Atlanta Tech Village. So basically, went on board at Atlanta Tech Village, on the fourth largest tech hub in the U.S., and really just built out their entire diversity and inclusion program or programming. And one of those things that came out of it was the It Takes a Village Pre-Accelerator program. Basically, is a program that helps startups that are led by women and people of color just gain access to community curriculum and capital. And ran that program for 2 years. Graduated 40 startups. Combined they raised over $1 million, generated over 2 million, and just with that particular experience, I was exposed to just the variety of different landscapes of the startup ecosystem as a whole. So you don't necessarily have to be a founder to be successful. You don't necessarily have to be a developer to be successful. I just saw the different avenues to be successful in the startup ecosystem. For me, not just having a startup company, and one of those avenues was venture capital. So I was always a resource in regards to helping people out and connecting the dots. But the next step for me was like, okay, how can I make a bigger impact? And that was capital. So I met Paige Craig summer of 2020, and he moved from LA, flew down here with his wife Laura, just to kind of stay close with the family. But they were unfamiliar with like the startup ecosystem, and from the universities to the founders, entrepreneurs here in Atlanta, and they were like, "Oh, this is great." They've been invested for 12 years and haven't invested in the South. So they created a fund. I love the vision that he laid out in regards to creating an inclusive team. So if you look at our partners now, including myself, you have Angetica. She is from New Jersey, but she's really from Nigeria. We have a very diverse group of individuals, women, Black people, Jewish people. So I love that it's one thing for a managing partner to say one thing and to do another thing. So it's very intentional. So that's why I kind of jumped on board with Outlander, because it really led my passion and my purpose of helping out my community, and also still creating that form of generational wealth that I want to do for the Black community and being tech. So that's kind of how I got into venture capital. So now I'm a partner at Outlander Labs, looking to expand the resources that I can provide for founders in the Southeast.
Cool. And I think for me, I began in a very traditional, very similar to Leslie, started an investment bank in New York, focused on equity research. So writing research reports. I was focused on the technology, media, and telecom sector. So that's really where I picked up kind of fundamental analysis, really learning how to look at top-down and bottom-up approach of looking at companies inside sectors and industries. As well as just financial modeling, understand how you actually pull together a business plan and how that translates to financials that would eventually run through your financial statements. So did that for a number of years. I really enjoyed that. Moved on to a consulting and business dev role inside of a major media conglomerate. There I worked, as I mentioned, somewhat as an internal consultant to help think through business strategies and problems, also evaluate potential acquisition targets that came in the door as well. So really kind of pairing together the financial piece of the story along with the strategy and operational side as well. And from that, and actually having a chance to interface with a number of potential targets that came through the door, saw a lot of companies that were VC backed, right? And just from seeing that process, that's where I really started to get a passion for the venture capital industry and kind of how they were partnering with companies early and helping them to do many of the things that I already was enjoying, whether I knew that was actually the case or not, from the operational and strategic side, as well as just how to deploy capital. So from there, went on it to another investment bank, actually, where I got a chance to do a lot more debt and equity, pure transactions, as well as M&A and private placements. So really, at that point, did that. I was actually on the West Coast doing that in the Bay Area. So got a lot of relationships there. Got a chance to meet a lot of people that were actually in the venture world or venture-backed startups. And so just kind of got a lot more exposure to the venture capital world from that point. Is also just being able to interact with a lot of VCs as we were thinking about trying to gain venture funding from the various folks on Sand Hill Road. So just got a chance to see that as well. So all those things really kind of excited me. Had a chance to gain a better appreciation for key areas that they were looking at. And then I think I reached a point where I said, okay, I'm relatively happy with where I am from a professional perspective. However, I'm not really as excited about, personally excited about what I'm doing on a day-to-day. So that's where I really, rightly or wrongly started to carve out and take some of my free time to just start doing my own personal investments, right? And what was interesting is a lot of the skill sets that I had built in a more strict professional environment all of a sudden were really helping me to make sound investments, right? And I'm pulling together, a true investment thesis. Why do I like this sector? Why do I like this company? And from that, realized, hey, the things I could really take these skill sets that I've used and use them in a way that could be, potentially very lucrative for me, while also helping to provide capital to people that I think are really smart founders and need the capital to really build some and solve some really interesting problems. So I think at that point, that's what really kind of jump-started me to really kind of take a all-hands-in approach to coming about venture.
Yeah, all of you have like amazing backgrounds. So I was wondering, what are some challenges that you face or that you see other people facing when looking to break into venture capital? And like, what advice would you give them to overcome those challenges? I know, Justin, you mentioned you have like an untraditional path. So any advice would be great.
Yeah, I think venture capital is kind of like a who's who kind of industry of, have to know somebody that knows somebody that knows somebody to get in. But in regards to like the way I kind of, I guess, broke in is really just being a value add to venture capital firms and different investors. And being a value add meaning like, with the program, like I said, we graduated 40 startups and, VCs and investors and accelerators will come up to me and say, hey, who's the best company, who's killing it, who has revenue, who's raised, and I can tell them everything. I would have like numbers to each startup through the program. So I think and that just allowed me to build relationships with angel investors, accelerators, and things of that sort. So if you're looking to break in, I think, step number one is just being a value add, not being, somebody that's like, hey, I'm just looking to learn. There's a lot of different resources online that you can kind of learn on your own, but the best way is to learn is by doing. So helping VCs with their deal flow, because majority of the time, of course, if they're actively investing, they're looking for new deals. So if you can, either create an event, create a quick competition, create a program, something that is a value add to them that, if you're something off of their plate, they're gonna, that's how you essentially get your foot in the door and build that relationship. Be a value add, and yeah, you can kind of work your way through there.
Yeah, I would just agree.
Leslie or Chad, do you have any advice?
What Justin said, I think that's great advice.
Okay, cool. Yeah, and I'm sorry, Leslie.
I was just going to say, I think one of the things that I love the most about venture is that it takes a lot of different types of people with different backgrounds and different experience to actually understand on the investment side, kind of looking at a company, getting it as a VC, unless you're super, super specific in the types of investments you're making, you always need other people's perspectives, and you're frequently working with other VCs as well. And people who have just a different way of viewing a particular problem. So if you have something that you feel like you're really passionate about and you see a fund or someone who that's part of what their thesis is, beyond just kind of deal flow, figuring out if there's ways that you can kind of help them research that particular market more, or understand it better. because you have some sort of affinity, natural affinity for something they're working on, I think is also a really good way, just because it's so great to be part of a community where you have creatives, you have finance people, and everyone kind of has to come together to build new companies and communities and all of that.
Yeah, thank you for that advice. And I think one thing that we've been reading a lot in the news lately is around the lack of diverse representation within the venture capital space, which in return impacts the dollars going to diverse founders. So can you all discuss the importance of increasing diverse representation within venture capital?
Yeah, I can take a stab there. I mean, it's not a myth, right? Like it is absolutely the case. There's empirical data that points to that. I think naturally, and Leslie hinted towards this a little bit, when you're doing, even from a diligence process, right? Who do you talk to? Why do you talk to them? What type of insights do you get from talking to people? I think it is important to be focused on just what that pool of references look like, because there is natural bias that always creeps into everything, all aspects of life. I think another part of being able to have a more diverse representation on the investor side is just naturally, if you think through networks, professional networks, academic networks, school networks, you're able to pull diverse investors are able to most likely be able to tap into a much wider, diverse network to be able to pull potential opportunities from as well. And if you're able to actually be in seats where you can actually, truly have a sway on what investments are able to be made, that's where you see capital really starting to redirect into new pools that previously they weren't available. So I don't think anything, I'm kind of a glass half full guy. I don't think any of this is like, anyone trying to box a certain segment of society out or a certain, race of people out. But I think there are just natural implicit bias that goes in and just kind of natural, social networks that directly impact where capital flows just based on the representation of the investor community.
Yeah, it's something that for us, we focused in on kind of immediately when we started putting together our thesis, the implicit bias thing, because people started sort of pushing us because we're both females, and they said, well, you should have quotas on female founders for your fund because you're women. And we just immediately said, that's not the point. It shouldn't just be for female. It should be diversity in every single way you can possibly imagine. The whole point is you should be looking at a universe of investments and making sure that you're making the best investment decisions and saying, okay, I'm looking at this one company that is, doing this one particular thing. Who else out there is doing that same thing? And are we not looking at those companies because they aren't in our networks, because we haven't been introduced for some reason? Or making sure that the reason that you're investing in a particular company is based on, the founder's ability to execute on what they're doing and not on any other factors. And I think that kind of builds into this implicit bias and figuring out how you really make that critical to your sort of the way that you make investment decisions, I think is super important. So I think more people are doing that. It's just a matter of figuring out how you build it into your pipeline development, how you build it into your diligence, how you build it into kind of every aspect of the way that you operate.
Yeah, and I'll add to that. I think representation is so key. Specifically, in the Black community. I say that one of the biggest reasons why I wanted to be in tech as a whole is to show that there's different wealth generating opportunities. So, you can be more than just, an athlete or entertainer to actually create generational wealth. And I think that, being not just a tech CEO founder, but also an investor. Because, I work with a lot of underrepresented founders, throughout my career thus far. But like, when they do get into these, investor meetings, there are a lot of investors that don't look like them. And I know that, of course, the big stat is like, less than 2% of, underrepresented, whether that's Black, female-led startups or LGBTQ, whichever it is. And that's the reason being is because, we need more diverse fund managers, who get these different type of problems that are being solved. I think that diverse founders bring a diverse perspective to problem solving just because they came from different communities that they've grown up and they see the world differently. So I think that if we have more diverse investors, then they'll get the exact problems that they're coming from because they're have empathy with these different founders. So I think, like I said before, it's about the ecosystem and as a whole. So it's not just about, hey, we're investing in diverse founders, but why not invest in a diverse angel program? Like, well, how can we create more diverse angel investors? Like, how can we create, the people that are athletes and entertainers? How can we educate them on venture capital and the returns on that? So, like, that's what I believe why representation is so key because it's not just it doesn't fall on just one party. Who should be diverse, who should be inclusive. It should be the whole ecosystem should represent what the world looks like.
And can I add just one quick thing to that too? I think another angle of this is thinking about board seats. And when you actually make investments in the company and portfolio support and making sure that the boards of these early stage companies are also diverse, like boards and C-suite, and having that influence as an investor to make sure that they're thinking about the composition of who is advising the company and has votes on making those big decisions, and also making sure that sort of the executive leadership teams of these companies, that it's something that's part of the thought process and something that the founders are really thinking about as they grow their company.
Yeah, and I think that's like a great segue into the next question. I guess overall, like how do you all believe that we can get more diverse VCs in general, and then also I guess in the Atlanta ecosystem? Because I guess most VCs are located, in Silicon Valley. So.
I'll touch on that. So I think the earlier you're exposed to different career opportunities, the better. Just for instance, with my story, like I didn't know what Silicon Valley was until I was like 21, and that just tells you exactly how far behind the curve, of my peers, in the space. So I think that programs like HBC, VC, that are really starting in and going through the college lens of like, hey, like you can. Here's the ecosystem as a whole. Like you don't necessarily have to be a startup founder, but you can actually be in venture capital. So I think starting off in colleges, high schools. I know we have a lot of like hackathons on the tech side of things, but why don't we have like more programming on the early side of being an investor? I think financial literacy and the financial empowerment is key as one of my passions and what I preach. So I think that like the earlier the better, so they can know that this is an actual opportunity. And I think that, like I said, high school, colleges, there are already organizations that are going and doing this programming. I think we should definitely support those programs because I think the earlier you're exposed to investing, the better you'll see that there's a variety of career opportunities in the space.
And so I guess in terms of venture capital, something that we hear a lot is about, how competitive it is to get in on hot deals. And so usually VCs have some type of strength that helps differ them from other venture capitalists that help them more attractive to founders. So I guess as a VC, what is your strength or what makes you stand out to founders?
Should I start? So that was actually one of the reasons why we set ourselves up the way that we did in being a sector-specific fund and focused on sustainability. So essentially, when we're investing in companies, we're pretty much the only sector-specific fund in apparel, production, and retail focused on sustainability, and all the companies that we invest in intrinsically built into their business models. There is something that reduces waste, is a new, environmentally better material, something that has a sustainability angle to it. So we are able to help them navigate the industry in a way that other VCs cannot. So it's really, we were focused on industry navigation and out of the gates, really deeply understanding their business models based on the fact that our thesis is around the problems that they're trying to solve. So we're just able to provide a different kind of support. So that's really where we come in and why we decided that we needed to exist and got the feedback that we should, because no one else was doing that. So I think having these sort of differentiating factors are super important.
Yeah, and I think from my end, the fact that there is capital now that is looking at a wider set of founders is fantastic, but it also creates some other potential issues as well, right? If you look at folks that potentially were having a hard time getting the attention of anyone, and now all of a sudden there's capital flowing from all over the place. And of course, I'm being overgeneralizing when I say that, but it's a a different seat to be in, right? So, not all capital is created the same, right? There are terms that come along with capital that you should be aware of. And I think from my perspective, having been in, the financial services industry and investment industry for quite some time now, I think really taking a partnership perspective and viewpoint of it and working with founders to say, hey, let's look at this together and kind of walk through what this means. No question is a dumb question. Let's look at it from that perspective. I think has resonated pretty well thus far with the market overall. And I think too, again, for me being a quote unquote professional investor in the venture stage is still a relatively new title, right? So I do have that same kind of outsider perspective, right? So, hey, here's this industry. Yes, I've been around it and aware of it, but I haven't necessarily been in it. And because of that, I have a lot better understanding of the thoughts and questions and issues that you're kind of processing through as you're thinking about how to go and build out a cap stack overall.
Yeah, and I think for me, I think it's just with my non-traditional background in the venture space, I look at it as an opportunity and as a strength because just for me, just bringing my personal experience and building a company, and just seeing like what it takes to actually build a company, how to raise capital. I know like the pain points of growth and scaling and and hiring and things of that sort. So I can really empathize with the founders, and I think a lot of people I've built relationships with, just in the ecosystem and building my company. So a lot of people around my age, I'm 27, so a lot of people around my age are like starting companies right now. So I have a good relationship with people who are building basically the future for tomorrow. So like I'm like, seeing the growth of these people that have started, at the same stage as me, but I went the VC route. They're still building the company. I think just leveraging those relationships that I've built up just over the past few years. And then lastly, it's just at Outlander, we're really, really hands-on. So like Chad said, like it's all about if you're raising capital, pick smart money. And I think the biggest thing with us is about helping companies. It's not just about the check. It's about like we're really hands-on in the sense of like helping that company grow and get to the next level. And I think a lot of people on our team are familiar with either that's programming or curriculum or just being operators at different funds. That is like our strength and our differentiator in regards to like investing. It's like we don't just do a check. It's like, what do you need help with as far as like what's your North Star metric? And then we rally our team and our mentor networks together to help you grow and scale exponentially. And just through my background and through all our team's background, that's what like our sweet spot is like helping companies grow, just from like either idea or like really like MVP stage to like in at least your seed stage. So a lot of us kind of combine our forces together to really help and help a lot of companies at the early stage.
Yeah, and I guess to go back to a question that we talked about earlier with the lack of representation within the venture space and how that translates to founders raising capital, I guess what advice do you give to minority founders looking to raise capital? Like what are some common challenges that they face and how can they overcome those challenges?
I think first, I'll just jump in here quickly. The first thing, and I'm sure Leslie and Justin have much better answers, but just remember as a founder, it is your company, right? Someone can only come into your company if you let them come into your company. So if you're dealing with an investor that's coming in and really trying to play hardball, you kind of have to make a character judgment on that capital too, and realize that it is truly a marriage. This isn't like a one-time thing. You're a partner going forward over many years potentially. So just be aware of that and really try to use your best judgment in terms of just dealing with a human element of a venture.
And I think fundraising is hard for everyone, unless you just have a network of incredibly wealthy people at your disposal to fund you in whatever you want to do, which is out there for a lot of people. It's not out there for me. I would imagine it's not out there for a lot of you. For us, for raising capital for our fund, which is also really challenging, I think it's finding, first of all, the best situation to be in is to not be fundraising and to start making connections with people who you have affinity towards for whatever reason before you actually need the capital. And I think the second thing is really focusing in on kind of what it is that you're doing and finding people with whom that resonates. And frequently, and that seems really straightforward, but a lot of times you get, like, we see founders coming to us and it's very clear that they're not a fit for our fund. And it just kind of breaks my heart a little bit because, you know, you sit there and you say, like, we have a very clear thesis. I wish we could help, you know, find some way to help you, but it just doesn't make sense. So be really thoughtful around who you're approaching. And oftentimes, you know, it's finding one sort of thing, whether it's something that that person did in their past career-wise, something that's sort of an affinity point, oftentimes overcomes a lot of sort of perceived barriers, whether that's like age, experience, whatever that might be, just finding where those places of common ground are and kind of focusing in on that, whether it has to do with your company or personally, I think is a really good way of starting to network and find the right capital for you as a company.
Yeah, and my advice would be, I think I mentioned it in message as well, is about, just like I said, that smart money and really just doing your research on the different, you know, investors that you're talking to. Like, there are thousands of investors, there are thousands of venture capital firms, but making sure that they align with your values as, you know, not just as a company, but as a person as well. So, like, I think Leslie or Chad mentioned it, like, it's a long-term relationship, you know. So, like, you know, you want to basically it's a partnership. So that's number one, is just like doing the research on the firm and just knowing their thesis. And before you know, go in and pitch, you know, before, you know, to kind of establish, like I said, does that make sense for you as a founder and what goals you're trying to accomplish, and them as a fund, what they're trying to accomplish. So if there's any like misalignment, then, you know, it's not going to be, you know, quote unquote, a good fit, you know. So I think that's number one thing. And then number two thing is just, for entrepreneurs, like, you know, of course, you know, venture capital investors, like, you know, we're giving the check, but, you know, we would be nothing without you all. So, you know, learning that you have the power and you all are creating the future, and just being really confident and passionate about what you're working on and what your idea is, and really conveying that vision, you know, because we mentioned like hot deals. I think, like I said, it's, you know, it's really about the team and the founder, and people who can really have a clear vision, have an awesome team, and is very confident in what they're working on and building. Because, you know, as early stage investors, we're investing essentially in the people and the person. So we're not necessarily looking at like the key metrics and growth. And that's cool, but like at this stage that we invest in, the Outlander is like really pre-seed, like seed stage. So we're still trying to figure it out. So we're investing in you. So if you're not confident in your vision and you can tell that, then, you know, that's what we call a not a good fit. You know, so I think that number one, smart money. Number two is really be confident in your vision.
And just another quick thing is, I think, you know, do your homework on who you're talking to always. Every pitch should be different. Like, you might have a deck or something like that, of course, but like you have to sort of know who you're talking to, who you're selling to, all of that. And one of my big things, even for us in fundraising, is like spend the first 2 minutes. Don't like go in hot on your deck and pitching. Like, spend the first 2 minutes or something getting to know the people, how they react to things, and spend a little time sort of feeling things out before you get started. And that seems like more kind of like personality advice, but I think it really makes a huge difference when you're kind of getting into things and you develop a different type of rapport. I think particularly in like this Zoom, like all like the Zoom days and all of that kind of thing, it's really important in person, but I think things get so disassociated when we're just seeing each other on video. I figuring out, just even if it's a quick thing to kind of break that up a little bit, so you just have a different relationship, I think is super important.
Oh, yeah. And quick, I want to add one more thing on that. To Leslie's point is, I tell entrepreneurs, your origin story is, is more. It'll tell me more about you as an individual more than your pitch deck will. So like it tells me about like the battle scars, how you persevered, how you pivoted. So that's essentially what we're looking for. Is like who are you as an individual, especially on an early stage. So like, first meeting shouldn't be just jumping straight into like the pitch deck and hey, this is my screen, this is the project. No, I want to know who are you as a person, like, and then we could worry about the other stuff as we continue on the conversation. But I think that first call is just getting to know one another. And like Leslie said, like nowadays with the Zoom aspect of things, you can't go in person and meet people. So like I think that initial conversation should be literally just getting to know you and then like letting that unfold organically.
Yeah, and one thing that you all mentioned in your answers is you touched on like the importance of knowing the fund's investment thesis, also potentially not being a good fit and also being too early. So I guess in terms of the different investment stages, what do you all look for in a company in those stages? Like for instance, during like the seed stage versus like Series A, for instance.
I'll jump in there. So I do look at seed and Series A. Obviously, at the seed stage, there's a lot less data points to actually be able to get your arms around. So I think it's, as Justin mentioned, who the team is. Can we have conviction in you and really understanding the problem? What is the actual problem that you're trying to solve? Many times we see solutions or products that don't really have a true problem. Right? So really being able to have a firm grasp of what the problem is that you're actually solving is hugely important. That's what gets me personally excited. Like, wow, okay, this is either it costs a lot of money or there's not a solution out there that's doing this and it's actually attached to a huge market. That's where I get really interested. I think on the Series A side, there are a few more data points around it. So you are starting to look at traction a little bit more. But one of the things I could quite honestly care less about is the financial projections. It's more about, do you understand, like if you have one customer today, how do the economics on that one customer work, right? How much does it cost to get that customer? How much can you make from that customer? And then how do you see that growing? But I think really understanding the economics of your business is a lot more important than telling me, how much revenue you're going to have in year 5 of the business.
Yeah. And I think now we can start taking questions from the audience. So Amber Smith, she asks, how did you go about educating yourself on the venture capital space so you could become a knowledgeable investor?
Yeah, I think for me, I read Venture Deals. That was a good book, just to kind of give me like a ground foundation. But I tell you what, like it's one thing to read it, and then it's another thing to actually do it. Like I've learned so much over the past couple months just being in the space. So, if you're able and capable of investing, I think that even if it's something small or your family and friends, like probably participating in the family and friends, not like first reading the venture deals, like I said, is a good resource to read it. But actually doing it, you'll actually learn like way more. So if you can possibly invest if it's either like $100 or $1,000 into a company that you really like or a friend, like that'll help you actually apply what you learn in a really short, cost-effective experiment. So I'll say those two things is just like Venture Deals by Brad Feld and just doing it.
Yeah, I was in a very, honestly, a privileged position in that I was in a group that was investing in venture funds, and I was on the limited partner advisory committee for those funds. So I got to kind of see the managers as they were making investment decisions, even before they started investing and understanding their theses, all of those kinds of things. But I do think that there are a lot of funds out there that have blogs and talk about how they go about investing and are very much like out there with all of that. So if you find different fund managers who have a thesis that really resonates with the way that you think about things, just follow them. Follow them on Twitter, follow their blogs. A lot of them have newsletters. It's a really great way of doing things. And frequently they have events too. And a lot of them have job boards. There's, so you can really see like what's going on with their portfolio, how things progress. So I think really following the managers that you're interested in is a really good way of going about things too.
What about you, Chad?
I'm completely in the Leslie camp on this one. What was kind of surprising for me as someone that, called myself a good student in school and went to business school and all these other areas, like, as I started looking around and asking people, they said, Fred Wilson, he has a great blog. Have you read it? No. That's the textbook of venture, other than venture deals, as Justin mentioned. Like, that's where a lot of the education is. Chris Sacca puts out a lot of stuff. All these kind of preeminent investors publish a lot, and so you just read and follow and pick up, and you get smarter and smarter. And they may mention a term you don't know. You go Google that term, that leads you down a whole other rabbit hole, and you just kind of continue to connect the dots.
Thank you all for that advice. So Dana Chrisman, she wants to know, what are some pitfalls you've seen during due diligence of diverse founders? What knowledge would you give from your side of the table to improve their likelihood of success?
I would say really, so we actually had, a deal that kind of fell through due diligence recently. And I think it's just about being very clear on, what the terms are, what the value is. I think, once both parties kind of agree on those things, I think that, that should be like an agreement. But then, of course, everybody knows once you send like a term sheet and you sign that doesn't mean that the deal is always through to do due diligence. But I think that the things. So I'm sorry, what was the question again? As far as due diligence, what fell through?
Oh, yes. What are some pitfalls you've seen during due diligence of diverse founders, and what knowledge would you give?
Yeah, that's what it was. So basically the terms aspect. So like once it was kind of mutually agreed on, and then try to renegotiate after the fact that it's been agreed on. I think that's one pitfall that I've seen a couple of founders try to do is like, hey, like, the deals were agreed on, but then after the diligence process, it was just kind of like a whole trying to renegotiate things kind of based off of other, I guess factors or investors or rounds. So I think having a very clear, like what are you raising, what are you willing to give up, and then like once the terms are set, just as a soft set, just kind of following through with those things. So I think that is one of the things like that we've seen. Of course, we're still kind of fairly new in the space, but I think that was the one thing, trying to renegotiate after like terms are agreed upon.
Leslie or Chad, do you have any advice?
I think one of the things two things I'd point to. One is if you think about being in a venture investor's seat, they're seeing a lot of companies, right? So your ability to be able to control the narrative as much as possible is helpful. What I mean by that is if you know you're going to go do a fundraising round, and this goes back to like knowing who you're talking to, if you can almost have, and I've seen people do this, almost have an investment memo prepared, right? And saying, here are probably the 15 most likely questions you're going to have for me. Here are your answers, right? And so what that does, one, is show that you're prepared. Two, it makes it easier for the venture investor to say, you know what, I got a heads up in terms of digging in and doing diligence, so I could probably move this along a lot quicker. And then I think the other part of it is you kind of know who your friendlies are as a founder. What I mean by friendlies is customers, people that are part of your supply chain, or however you're making what you're making, knowing who you can refer certain founder or certain investors to that are probably going to be pretty strong endorsements for you and your product or solution would also help to kind of further credentialize you and show that you're kind of smart and you're going about a pretty interesting problem.
Totally agree with what Chad just said, and that was what I was going to say. Have a really great data room that basically has like FAQs set up, know who your competitors are, know what differentiates you. Don't be afraid to talk about it. You know, and that's all a huge part of, you know, making a decision easy for someone.
Yes, definitely. Thank you. And Jay, his question is, how do you really vet and find the right investors who invest in minority-led founders? I often see there are not many VCs who understand education well. They understand tech, but the part behind the industry isn't apparent. So how do you really find the right fit?
And I think for me, what I've seen is you got to pound the pavement. I don't know if there's any way around it on that. You know, like there are some names, you know, like K4 Capital, right? For one, like they're probably more well known. If you can go and look to see who has invested in or what their portfolio companies are and who has also come into rounds with them, that's a good way to kind of give you a strong foundation of who are the 15 to 20 most likely venture firms that I could start with. And then from there, just kind of follow the tree out. But I don't think there's any strong replacement, or I don't think there's a software or app that tells you here are the 30 folks that you should go after. I think you kind of have to follow the tree out from a couple strong sources or people that are more active in your particular sector.
And I think always keeping in mind that just because a fund or a manager has invested in a particular theme or something doesn't mean that they're going to do it again. So particularly if they have a portfolio company that's doing relatively well and it's clear that it's something that has legs, at least conceptually, try to find a competitor fund to them rather than going to the company that's already invested in them. I mean, try, but you're probably going to have more success with someone who missed that deal and is looking for an opportunity in the same space if you feel like you have something that really differentiates you from the company that has some traction. So I think that that's probably important.
And another question that we have is from Amber. When you're looking to start as an investor, how do you go about getting funds to companies? An example through your personal funds by raising funds. So I guess they're asking, how do you raise a fund, a venture fund? Yeah, I don't know if anyone on our panel has that experience.
Yes, so it's basically you start with a thesis. The way that we did it is we started, you know, building a pipeline, looking at what the investable universe around the idea and the framework that we had that we wanted to invest in, seeing what companies were out there, starting to talk to them, being really clear with the founders of those companies that we did not yet have capital, but we intended to raise a fund down the road, and starting to build those relationships. And then as we continued doing that, and we sort of made a list of who our dream investors, dream limited partners for our fund would be, and started trying to find ways to be introduced to them. And that is how we've raised our capital so far. It's from, you know, some connections that I had through my experience in the impact investing space. But a lot of it has been sort of saying, looking out there and saying, you know what, I think that this person would be really interested in what we're doing. I know they do venture investing. How can I get an introduction to them? And it's really, really hard. And it takes a really long time. But if you have a thesis that you believe in, and you find companies that want you to invest in them because you have something that's differentiating that you bring to the table, and they'll vouch for you, it starts happening. But for us, to be totally transparent, it's taken us 3 years to even get to a point. I mean, it took us 2 years to get to a point that we were investing, and 3 years now that we really have some sort of volume on the fund. So it's not for the faint of heart. And being a first-time manager is extremely difficult to raise capital. And there aren't that many resources out there. There are a lot of resources for founders and accelerator programs and all those types of things. But when you're a manager and what you need is capital, like you support's important, but like in order to do your job, you actually need assets under management. Finding that capital is a challenge.
Wow.
But it's a finding the people who what you're doing resonates, and sort of having a really thoughtful process around fundraising.
Wow, thank you for that. And I think the last question that we have from the audience is from Kareem. Is just really a question around ownership. So when you're making an investment, how much do you aim to own, if that's something that you look at?
Yeah, so at Outlander, we're very transparent, and when it comes to equity, you can see it on our sites, between 8 to I believe 12% equity. And the earlier, of course, the more equity will take, the later. As far as the more traction you have, of course, the less that it's possible that will take. So and this is just for entrepreneurs or founders, if you can de-risk an investment, you can essentially negotiate better terms. So if you say, hey, we bootstrapped, now we have $1 million ARR in revenue. This is why we're valuable, and this is what we're taking your money to scale. Then that's a different conversation that you come into saying like, hey, we have an idea, and just now getting this off the ground. So that basically ranges. So that's okay. Well, that's a higher risk that we're taking on, so we have to take more equity. But if you are de-risking your investment by having traction, having customers, then we possibly could take less equity. And that's just like a simple rule of thumb, in regards to just investing and risk management and things of that sort. So that's an easier broken down way to look at
Leslie or Chad, do you all focus on ownership, or is that not really that important to your funds? No.
It is important, and I think a similar sort of mindset to what Justin said. It just completely depends on where we see the company, what we see the addressable market being, where they are in terms of what kind of risk we're taking for technology risk, all of those types of things. So it's important, but we don't have thresholds that we stick to for that.
Thank you. Well, that's all the questions from my end and also from the audience. One, thank you all for all of your time today, and also all of the advice that you were able to give to the audience and also to myself. It's definitely been insightful. Something that someone dropped in the chat: how can founders get in touch with you all?
Yeah, you can. LinkedIn will probably be the best way. So this is Justin McLeod, first name, last name on LinkedIn. That'll be the best way. And if you have a company, a startup, visit outlanderlabs.com. We have a form, you can just fill that out, and we'll basically fill that out, and we'll invite you to our office hours. That's a way where you can actually pitch our team, and kind of start that process in regards to our investment process. So if you're a founder, go to outlanderlabs.com. If you want to connect with me personally, LinkedIn is definitely fine.
Same here, LinkedIn for personally, and then we have a form on our website at Alante Capital if you're interested and you have a startup that's in our purview.
Yep, same here as well. LinkedIn is a great place to get started.
All right. Well, thank you all for your time today, and thanks for connecting. Really enjoy the conversation, and looking forward to seeing what's next for you all. So thanks for your time.
All right, thank you.
Thank you.
Bye.
Bye.